The regulation of stablecoins. You've probably heard of them: Tether, Binance USD, USD Coin, True USD. The list goes on, and more are likely to follow in the future. They are not your regular cryptocurrencies. They are called stablecoins. Since the first stablecoin was issued in 2014, the cryptocurrencies have gained traction in their use, mostly thanks to their stability, security, and transactional speed. The absence of volatility present in most other cryptocurrency blockchains means investors and traders can rest easy knowing that their assets are safe and tied to the value of government-tied currencies, or to commodities like gold and such other precious metals. To be employed as a cryptocurrency, an asset has to be able to act as a store of value, a medium of exchange, and a facilitator of commerce. Stablecoins are beneficial in the performance of these requirements as they easily bridge the gap between crypto and fiat. Volatility in leading cryptocurrencies can be measured by studying an asset's percentage in points movements, but stablecoin holders know that their holdings will not change over short periods. After all, they are backed by a central stable commodity. Stablecoins have numerous applications involving various participant kinds and contractual structures, raising a variety of regulatory issues. Regarding investor protection and market integrity, stablecoins and stablecoin agreements can create some serious problems. Now, here is the problem. Trading operations involving digital assets and stablecoins may fall under the Commodities Futures Trading Commissions, that is the CFTC, or Securities and Exchange Commission, better known as the SEC's purview. A stablecoin may be a security, commodity, or derivative implicating the SEC's jurisdiction and subject to federal securities law, or it may implicate the CFTC's jurisdiction depending on the facts and circumstances. But what happens when assets like stablecoins are ill-managed or not regulated? Is there any truth to the rumors of contagion risks to wider financial sectors? Here's why there's a need to regulate stablecoins. Most investors are glad that financial regulations are figuring out how to best regulate stablecoins, as their growth has the potential of creating significant risks. In markets where growth is imminent, it is always advisable to have governing authorities use the tools at their disposal to maintain order while improving access to financial payment systems. Digital tokens like stablecoins, whose value is tied to another asset or currency, provide investors transferable value between cryptocurrencies and exchanges without needing to go back and forth between fiat currencies. Yet they are yet to be regulated in any substantive way. Doesn't make any sense, right? Because they are the cryptocurrency ecosystem's equivalent of money market funds. Regardless, these tokens still act as money. Some issuers obtain state licenses, which impose requirements on the cryptocurrencies, and in a world where the market cap of stablecoin sector is over $150.60 billion, any sudden spike in demands for withdrawals could make a stablecoin create damage not just to the cryptocurrency market, but to the financial market at large. That is, unless regulations are put in place. Users of stablecoin would be harmed, and there may be systemic risk if it operates as expected. While there are stablecoin that have retained stability through the twists and turns of the market, the crash of Terra USD showed the crypto world just how fast things can go south. Terra USD is an algorithmic stablecoin, which means that a computer program running codes maintains the supply of the crypto. It was pegged to the USD at $1 with its Luna token. But while Luna was meant to buffer Terra USD against the market's volatility and help Terra to maintain its 1-to-1 peg value with the US dollar, it fell to extreme demand over a short period. In just days, its trading price was reduced to 0.3 cents. There were efforts to save the stablecoin, but they mostly backfired and even increased the volatility of Bitcoin. The implosion of Terra was a wake-up call, and it put other stablecoins on their toes. Tether, USDT, is currently ranked third on CoinMarketCap with a live market cap of $69 billion, followed by USD Coin and Binance USD. In May, USDT dipped below its peg to the US dollar, but returned soon after, just not before its future was called into question. This and the Terra USD crash shed light on the counterparty risk involved with stablecoin, i.e. the likelihood that a party involved in an agreement might not have the reserves they claim to possess. With Terra USD's crash, the attention of the US Treasury was caught, and regulatory frameworks are now needed to ensure that history does not repeat itself with other stablecoins. Algorithmic stablecoins like Terra USD can lead to Ponzi schemes as well, where new coins are created only through users depositing collateral. This is yet another reason why regulation is necessary, as fraudulent schemes like these eventually collapse when there is no new investors to make investments. One question is, can regulating stablecoins advance financial inclusion? There is that potential, as stablecoins and central bank digital currencies, that is CBDCs for short, have a broad impact in the cryptocurrency industry and even beyond. Of course, this depends on how they are utilized. Financial regulators aim to remedy deficiencies in payment systems and increase access to financial systems for the average trader. At the moment, most investors would agree that the system is fine, but the flaws are felt keenly by those in the lower income bracket. Stablecoins should speed up and revolutionize the system, but it needs to be coupled with regulations that will create more issuers and competition. Regulators frame the system's deficiencies as they try to impose requirements on stablecoins so that the investors are not left at the mercy of price collapses should they happen, like in the case of Terra USD. This way, authorities can take immediate action in the market as transactions occur. They can distinguish between stablecoins with reasonable policies and those without, as the industry develops. To properly execute the proposals proffered by regulatory bodies, coordination between different government entities would be required. This would necessitate the backing of federal financial organizations, including the Federal Reserve Board, along with other regulatory agencies. It is worth the note that regulations are coming in small steps. The International Organization of Securities Commissions, the IOSCO, in October 2021, proposed that stablecoins can be regulated as crypto market infrastructure with payment systems as well. The rules recommended focuses on stablecoins that are considered important to the market by agencies and regulators. For example, the stablecoins with the ability to disrupt settlement and payment transactions. The government of the United Kingdom announced similar measures in their bid to regulate stablecoins. They would bring stablecoins within existent transaction regulations, thereby paving the way for their utilization in the UK as recognized forms of payment. The measures permit legislating the regulation of the crypto market's infrastructure while encouraging experimentation and innovation on the blockchain, and within decentralized autonomous organizations, DAOs, as well as digital communities. By the end of the fiscal year, lawmakers and authorities predict a set of standards for the stablecoin industry will be in place. In the US, stablecoin discussions are centered on a few key policy issues, recommendations that stablecoin only be issued by federally insured banks, but that is facing fierce opposition from members of Congress, many of whom want state authorities to be authorized to license stablecoin issuers. A set of laws will probably be implemented before the end of the year, given the importance that of stablecoin regulation has since the Terra USD meltdown. They might include some of the following. First, the word security does not include a payment stablecoin, as that term is defined in Section 2 of the Stablecoin Trust Act of 2022, is added at the end of the Securities Act of 1933. And a state-chartered money transmitter, a national restricted payment stablecoin issuer licensed by the controller of the currency, or an insured depository institution may all issue payment stablecoins. The key here is trust transparency and action. Stablecoins are part of a rapidly growing industry, and issuers of algorithmic stablecoins need to provide a thorough explanation of how their systems function, the assumptions that underlie them, and the potential knock-on effects that a change may have on other areas of the coin's larger ecosystem. They must act quickly to reform themselves, set up best practices to favor longevity and stability, and aggressively collaborate with regulators to further these goals while fostering ongoing innovation and experimentation. This might sound like quite the task to take on, but again, in small steps, these regulations will not only aid the stablecoin in the long run, it would also help the market as a whole. Regulatory authorities will not be able to enact smart laws without the right training and the ability to differentiate between the subtleties of various stablecoins. The regulation of stablecoins would mean that effort is being made to ensure that the market can attain a sustainability that is much needed to protect investors. What are your thoughts on the regulation of stablecoins? Leave a comment below. Also, like the video and subscribe to the channel so you never miss any of our high-value uploads. Thanks for watching.